Welcome back, everyone. Ready for another deep dive?
Definitely.
Okay, great. Today, we're going to tackle a pretty important part of the global financial system. We're talking about, you guessed it, correspondent relationships.
Mm-hmm.
You know, those partnerships where one financial institution, provides services to another one, especially when things, have to move across borders and stuff.
Right.
And it's not just like your typical banks anymore, right? Fintechs are involved, crypto's in the mix, even those, what do you call them? Those virtual IBANs you might have heard about?
Yeah. Those are becoming more common.
It's a whole, complex web these days.
It really is.
And it's super important, right? I mean, we're talking international payments, trade finance, basically all that stuff that keeps, global commerce, the world of business, actually running.
It's the nuts and bolts of how the world does business. You got it.
Exactly. So to help us, sort through all this, we've got a real expert here who knows this stuff inside and out.
Glad to be here. It's always a fascinating area, and it just keeps changing all the time.
Okay, so let's start with the basics.
Mm-hmm.
What exactly is a correspondent relationship? I mean, for people who might not be, totally familiar with the term.
Sure. So at its core, it's basically one financial institution. They call this one the correspondent, and they're providing services to another one called the respondent.
Okay.
You can kind of think of it like your bank having a bank account, at another bank.
Okay.
But on a global scale. This account, though, they call it a Nostro account.
A Nostro account, got it.
And it's super important for moving money, across borders, for handling those big trade finance deals, and just for managing cash flow, especially for businesses that are operating internationally.
So it's like a checking account, but for banks and for global transactions.
Exactly.
Okay. That makes it much easier to picture.
Good.
But you mentioned it's not just traditional banks anymore, right? How do these fintechs and crypto companies, how do they fit into all of this?
Well, that's where things get, really interesting.
Okay.
Organizations like, for example, the Bank for International Settlements, the BIS.
Yeah.
They're actually broadening the definition.
Interesting.
They're saying it's not just about the type of institution it is, but more about the function that they're performing.
The function. Okay.
So they highlight things like bilateral agreements, right? Account openings, and especially payment services. That's really, kind of the foundation of these relationships, they're saying.
Gotcha.
And the EU, the European Union, they've actually taken this even further.
They're really going for it.
They're recognizing that institutions like crypto asset service providers,
Yeah.
they can offer similar services. So they've actually expanded their definition to include those guys.
So it's like the financial world is realizing that these functions are important, no matter who's doing them, really.
Yeah, that's a great way to put it.
That makes a lot of sense.
Yeah.
But doesn't this, this blurring of lines, doesn't create maybe some vulnerabilities? Where are the weak links in all this?
Well, that's a fantastic question, and you've hit on a really crucial point here.
Mm-hmm.
These relationships, they rely heavily on trust.
Makes sense.
But there's a saying, right? Trust. BT verify.
I like that.
That's where regulatory oversight comes in.
Okay.
To make sure everyone's, complying with the rules and to prevent these partnerships from, being exploited. Because there are people who might try to use them for criminal activities like, money laundering.
Yeah, definitely. I can see how that could be an issue, especially with all these new, players coming into the scene.
Mm-hmm.
Can you give us a real world example of how things can go wrong when these relationships aren't managed well?
Oh, absolutely. Remember the case of ABLV Bank?
ABLV Bank,
over in Latvia.
Right.
They were accused of facilitating money laundering. And the U.S. Treasury, they basically cut off their access to correspondent banking relationships.
Wow.
So without those connections, they couldn't, process any transactions, led to a bank run, and, the bank basically collapsed.
Wow. That's a pretty stark reminder of how important these relationships are.
Yeah.
And how quickly things can, fall apart if there are problems. But it makes me think, couldn't a bank's reputation suffer even if they're not directly involved in any wrongdoing?
You're absolutely right. That's a great point.
Yeah.
The ABLV Bank case, it really highlights the importance of not just, relying on a correspondent's reputation, you have to do your own due diligence.
Right.
You got to really understand their risk profile.
Okay, so you got to do your homework.
Exactly. And remember, even seemingly small missteps, they can have huge consequences. Like, for example, take Standard Chartered Bank.
Yeah, I've heard of them.
Over in the UK,
Yeah.
they were fined a massive amount.
Right.
For not managing their correspondent banking relationships properly. And this was even years after the initial, violations had happened.
Wow. So the stakes are pretty high.
They are. It's a delicate balance.
Yeah. It sounds like walking a tightrope. But why are these relationships so particularly vulnerable to money laundering? Like, what makes them such attractive targets in the first place?
Well, it boils down to, I think, two key factors.
Okay.
One is these indirect customer relationships.
Okay.
And the other one is just the sheer volume.
Volume of what?
Of everything. When a correspondent bank is processing a transaction, a lot of times they're dealing with the respondent's customers, people they don't even know.
So there's like a chain of trust involved.
Exactly. And, any weak link in that chain can be exploited.
Makes sense.
And then you add in the massive number of transactions that are flowing through these networks.
Yeah, that's got to be a lot.
It's like trying to find a needle in a haystack when you're trying to spot, the suspicious activity.
Oh, wow. Yeah, that makes sense. It sounds like it would be incredibly hard to keep track of it all. Especially, when you think about things like those, what are they called? Nested correspondent relationships.
Yeah.
Where you have multiple intermediaries, right?
Right.
And then those payable through accounts where, like, a respondent bank's customer can just directly use the correspondent's account.
Yeah. Those are tricky. They add, even more layers of complexity. It really is like trying to unravel a tangled web.
Okay.
Yeah.
But luckily, there are ways to manage these risks, right?
Yeah.
Effectively.
So absolutely.
That's good to hear. Okay, so let's dive into that a little bit.
Okay.
What are some of the key things that financial institutions can do to, like, build these robust risk management frameworks, to actually protect themselves?
Well, it all starts with, due diligence.
Due diligence.
Yeah.
Got it.
But going way beyond just accepting what the respondent tells you.
So you're saying don't just take their word for it, even if they've got a good reputation and all that.
Right. You can't just assume everything is fine. There's this questionnaire they use. It's called the Correspondent Banking Due Diligence Questionnaire, CBDDQ.
CBDBQ.
Yeah. It was created by the Wolfsburg Group. It's it's a good starting point.
Okay.
But it's just that. It's a starting point. You got to verify the information, assess their anti-money laundering policies, talk to their staff, review their audit reports, internal and external. And even in some cases, you might want to consider doing on-site visits.
Wow.
Yeah.
So you really have to, like, get in there and look around.
You do, because essentially you're vouching for the respondent's actions, right?
Yeah, it's a big responsibility.
It is. You need to be confident in their compliance.
Okay, so that sounds like a really thorough process.
Yeah.
Is that like the level of scrutiny that's required for all these correspondent relationships? Regardless of who the respondent is.
Sure.
Or are there, like, certain red flags that might trigger even more, in-depth scrutiny?
That's a great question. There definitely are certain risk indicators that should raise some eyebrows. The UK's Joint Money Laundering Steering Group, they call it the JMLSG.
JMLSG.
Yeah. They've highlighted a bunch of these things like, the respondent's location. Like, are they in a place that's considered a high-risk jurisdiction?
Oh, hey.
What about their ownership structure? Is it transparent?
Right.
Or are there, hidden beneficiaries?
Right. You don't want any surprises there.
Exactly. And the types of customers they serve, that matters too. Are they dealing with high-risk industries or people who, maybe have a reputation for shady dealings?
You got to look at their clientele.
Yeah. And finally, are they involved in any activities that are inherently risky? Things like, handling large amounts of cash or offering those really complex financial products that don't have a lot of oversight.
So it's not just about who they are, but what they do and where they're operating.
Exactly. You got it.
Okay. That makes sense.
Yeah.
But even with all this due diligence, how can you be sure that everything's running smoothly once the relationship is actually in place? How do you keep an eye on things?
Well, that's where transaction monitoring comes in.
Transaction monitoring.
Yeah.
Right. Okay, but isn't that, like, pretty standard practice?
It is. But with these relationships, it's not as simple as just applying the same rules you would to your own customers.
Why not? What makes it different in this context?
Well, think about it. You're dealing with transactions from the respondent's customers, not your own.
Right. So
your traditional monitoring methods, they might not be enough. You need a system that can account for that indirect nature of these relationships and the fact that there's just a way higher volume of transactions happening.
So how do you tailor the monitoring to effectively manage those risks? What are some practical steps that institutions can actually take?
One crucial strategy is to segregate accounts.
Segregate accounts. Okay. What does that mean exactly?
So the respondent, they should have separate accounts for different purposes, like one for their operational expenses, another for their clients' funds, one for transactions with downstream correspondence, things like that.
So you're basically creating a clearer picture of their activities.
Yeah.
Making it easier to spot anything that looks, out of place.
Right. Exactly. It's about compartmentalizing things.
That makes a lot of sense. Mm-hmm. But what about the actual monitoring rules? Like, how do those differ from the ones you'd use for your direct customers?
That's a key point. You need dedicated rules that focus on the respondent's activity as a whole, not just their individual customers' transactions.
Can you give us an example of what that might look like in practice, like a real-world scenario?
Sure. There's this company called AMLYZE.
AMLYZE, okay.
They build software to help institutions manage these relationships. And they had a really interesting case study. They were working with this payment service provider.
Okay.
And this provider was using a crypto asset service provider as a correspondent.
So crypto's involved here.
It is. And AMLYZE, they set up these specific monitoring rules. They were looking for unusual transaction patterns coming from the crypto provider's clients.
And did they find anything?
They did. They uncovered a potential investment scam.
Wow. Really? So their system actually worked?
It did. Their monitoring rules flagged this high-value transaction that it didn't look right. And when they dug into it, they found out it was linked to a company that was claiming to offer these, unbelievably high returns.
Oh, yeah, those are always red flags.
Right. But the company, they didn't have the necessary licenses.
Yeah.
That's a big problem.
So they were basically like a fake company.
Pretty much. And if AMLYZE hadn't been monitoring those transactions so closely, they probably would have gotten away with it.
Wow. So these specialized rules, they actually help prevent a crime from happening.
They did. It's a perfect example of how important this approach can be.
It definitely sounds like institutions need to be thinking, outside the box. They need to be adapting their systems to account for the unique risks that come with these correspondent relationships. But is there anything else they can do beyond due diligence and transaction monitoring to really ensure these partnerships are, being managed effectively?
Well, communication is absolutely key. Both the correspondent and the respondent, they need to be proactive about sharing information.
So it's more than just, a transactional relationship. They need to have a real partnership, one built on trust and transparency.
Exactly. Any changes in ownership, management, compliance status, the correspondent needs to know. And they should be open to audits, willing to share the findings, and constantly working together to improve their AML processes.
So it's like a shared responsibility, really, to protect the integrity of the whole system.
Yeah.
I like that. But tell me, what are your thoughts on the role of technology in all of this? Can it play an even bigger part in managing these increasingly complex relationships?
That's an excellent question, and one that deserves its own deep dive, actually.
Well, stay tuned, everyone, because that's exactly what we'll be exploring in the next part of our deep dive into correspondent relationships. We'll be right back.
Technology, yeah, there's already playing a huge role, but there's definitely room for it to have an even bigger impact, I think.
You mentioned that deserves its own, deep dive, but can you give us a little sneak peek? What are some of the areas where you see technology really, making a difference here?
Well, one that comes to mind right away is data analytics.
Data analytics, okay.
I mean, imagine being able to analyze massive amounts of transaction data to spot patterns and, anomalies. Stuff that might, point to suspicious activity. And I'm not just talking about looking for red flags in, individual transactions.
Right.
But analyzing, the bigger picture.
Okay.
Looking at the respondent's entire network, all their relationships, all their transactions, to find those trends that you might miss if you're just, focused on the little details.
So it's like having a bird's eye view of the whole financial ecosystem, right?
Yeah, exactly.
You can see the connections and how the money's actually flowing, which you wouldn't be able to see otherwise.
That's the idea.
But wouldn't that require a ton of data sharing?
It would.
And collaboration between all these different institutions.
Absolutely. And that's another area where technology can really help.
Okay, how so?
We're starting to see these secure platforms popping up, data sharing initiatives. They allow institutions to, share information, but in a controlled way, so everything stays compliant.
Gotcha. So it's like a safe space for sharing sensitive information.
Right. And that kind of collaboration, it's really essential if you want to manage risk effectively in this, super interconnected world.
That's fascinating. It sounds like we're moving towards a more interconnected and transparent financial system.
I think we are.
Which could be like a total game changer for fighting financial crime, right?
That would be huge.
But what about artificial intelligence? Where does that fit into all of this?
Oh, AI has the potential to completely revolutionize how we approach risk management.
Okay, in what way?
Imagine AI-powered systems.
Right.
Not only can they detect suspicious activity, but they can actually learn from past cases and even potentially predict future risks.
So it's like they get smarter over time.
Exactly. They can help institutions stay ahead of the curve, proactively address those vulnerabilities before they turn into, big problems.
That's pretty amazing. It sounds like something out of a, sci-fi movie.
It does a bit, yeah.
But it's also kind of, I don't know, a little daunting. Are we talking about machines making decisions about who's trustworthy and who's not?
That's a valid concern. It's important to remember that AI, it's a tool. It's not meant to replace human judgment. It's meant to augment it, enhance it.
Okay.
The goal is to use AI to help us analyze information better, identify risks more efficiently, and ultimately make better decisions. Humans will always be, in the loop.
Right.
Providing oversight and ensuring that, we're taking ethical considerations into account.
Right. So it's about finding that right balance between human expertise and the capabilities of technology.
Exactly. That's the key.
Earlier we were talking about AMLYZE, that company that builds software, to help manage these relationships.
Yeah.
They mentioned some interesting things on the tech side. In their report, they were talking about moving to the Google Cloud platform.
Yeah.
And they're implementing this new feature for manual case creation.
Oh, that's a big move for them. Migrating to a platform like Google Cloud, it gives them so much scalability, flexibility,
right,
which is crucial for a company like that that's, dealing with just massive amounts of data. They can grow, they can adapt to the, changing needs of their clients, and the manual case creation feature. That's interesting.
Yeah, why is that?
It shows that they get it. They understand the importance of human judgment. It's not all about automation.
So it's not just about relying on these automated systems. You still need that human element.
Sometimes, yeah. Sometimes you need a human to really dig into things, investigate potential issues that the algorithms might miss. It's about, finding that balance.
Right. Balance between the automation and the human oversight.
Exactly. That's the sweet spot.
It's interesting how they're embracing both, this cutting edge technology and the importance of human expertise.
Yeah, they seem to have a good approach.
But in their report, they also talk about the importance of partnerships.
Of course. Yeah.
They mentioned some big names like Finastra, that major core banking provider, and ID Now, the leading identity verification company.
Those are strategic partnerships for sure.
Yeah.
Integrating their solutions into the broader financial ecosystem. It's essential for a company like AMLYZE. It shows that they understand that collaboration is key. No one can do this alone.
Right. It's a team effort.
Absolutely.
It seems like they're really positioning themselves as a key player in this whole evolving landscape. They even mentioned going to these big international events and expanding their marketing efforts. I guess they're, aiming for some serious growth, huh?
That's the sense I get, yeah. And with all the increased focus on correspondent banking relationships from, regulators and everyone, I think they're in a good spot. Definitely a company to watch, I'd say.
It's fascinating to see how technology is shaping this whole field, and how companies like AMLYZE are, they're adapting, they're innovating just to try and meet these challenges. But let's zoom out a bit. We've talked a lot about the technical stuff, the nuts and bolts of managing these relationships. Yeah. But what about the human element? What are some of the qualities that make for a truly successful correspondent banking relationship? What does that look like?
That's a really important point, because ultimately, these relationships, they're built on trust and mutual understanding. It's not just about the technical stuff, the due diligence, It's also about having open communication, clear expectations, and a shared commitment to compliance.
So it's like you're saying, it's more than just a business deal, right? It's got to be a real partnership.
Right. both parties have to be invested in making it work. And that means being, proactive about sharing information, addressing concerns, and just working together, constantly to improve their AML processes.
So it really is a shared responsibility then to protect the whole financial system.
It is. And that responsibility, it extends beyond just the individual institutions. Regulators, industry groups, technology providers, they all have a role to play.
Right. So everyone's got to work together.
Exactly.
Yeah.
To create a more secure, more transparent, global financial ecosystem.
It's been really interesting to see how the whole concept of a correspondent relationship has evolved. We've gone from this traditional bank-to-bank model to this much more complex web that includes, fintechs, crypto companies, virtual IBANs, all these new technologies. It's a lot to take in.
It is. It's a lot, but it's a testament to how interconnected the world has become, and it really underscores the need for these risk management frameworks that are adaptable, that are robust.
Speaking of adaptable, what do you see as the biggest challenges facing this whole field in the years to come? What should institutions be focusing on to stay ahead of the curve, to stay ahead of the bad guys?
One of the biggest, I think, will be keeping up with technology. I mean, it's moving so fast.
Yeah. It's hard to keep up, for sure.
As new technologies come out, the criminals, they're going to find ways to exploit them.
Right.
Institutions have to be proactive. They have to understand these new technologies, and they have to adapt their risk management strategies.
It's like a constant game of cat and mouse, isn't it?
It really is, yeah.
But what about the regulatory landscape? Do you think that, regulations are keeping pace with all these changes?
That's a good question. Regulators, they're definitely aware of the challenges, and we're seeing a lot of, activity in the space. But it's a tough one. It's a complex issue. Trying to find that balance,
Balance between what?
Between fostering innovation.
Right.
But also ensuring that the financial system stays stable.
So you don't want to, stifle innovation, but you also need to protect the integrity of the system.
Right. And that's why it's so important to have, an open dialogue, collaboration between regulators, the financial institutions, and the technology providers.
So it's that team effort again. Everyone's got to be on the same page.
Exactly.
It sounds like we're entering this whole new era of financial services.
Yeah.
Where the lines between traditional players and these new entrants, they're getting blurry.
Yeah, the lines are definitely blurring.
Technology's evolving faster than ever before. And the risks, they're just getting more and more complex. It's a lot to keep track of.
It is. It's an exciting time, though. Lots of opportunities. And lots of challenges.
Definitely both sides of that coin, yeah. But understanding these relationships, these complex relationships, it's crucial for anyone who wants to, really navigate this rapidly changing landscape.
No question about it. You got to understand the fundamentals.
Okay, so we've covered a lot of ground today.
We have.
We've explored the ins and outs of correspondent relationships, the changing regulatory landscape, the role of technology in managing risk, and of course the importance of collaboration and communication. But I will leave our listeners with one final thought to ponder. We've talked about due diligence, how important it is in these relationships.
Right, right.
But as these networks, as they get more complex, more interconnected, all that stuff,
yeah,
I kind of wonder, how can we make that due diligence process, even more robust, more efficient? Can data analytics play a bigger role, in enhancing due diligence?
That's a great question to leave our listeners with, actually. It's something that I think everyone in this space is really thinking about. Regulators, financial institutions, the tech companies, everyone.
So there's a lot of potential there then.
I think so, yeah. A lot of potential for technology to streamline the due diligence process. Make it more effective. Maybe even help us anticipate those risks before they even pop up.
Okay, can you give us an example? What would that even look like in the real world?
Sure. Imagine a system.
Right.
And it can automatically analyze a respondent's financial records, their transaction history, even their public reputation.
Okay, yeah.
And this system, it could flag potential red flags, identify those beneficial ownership structures, the ones that might be kind of hidden, and assess their overall risk profile and do it all in way less time than it would take a human analyst.
That sounds amazing.
Yeah.
But wouldn't that also, raise some concerns about bias?
Yeah.
And fairness? What if we end up with a system that that unfairly penalizes certain institutions or people based on bad data or algorithms that aren't, quite right.
You're absolutely right. That's a critical point. As we, start to delegate more of these tasks to machines, we have to be very, very careful about potential biases that might be, kind of baked into the algorithms.
Right.
It's super important to make sure that these systems are designed, with fairness in mind.
Yeah.
And transparency.
Yeah.
And that humans are still, part of the process to make sure everything's okay, to provide that oversight and to, use their judgment.
So it's not about, replacing human judgment altogether.
No.
It's more about giving human analysts, better tools. Better information.
Exactly. Technology should be used to make us better, not to, replace us entirely. Mm. The goal is to create a system where humans and machines are working together, to make sure those correspondent relationships are managed safely, responsibly, and efficiently.
That's a really important takeaway as we, navigate this increasingly complex world of finance. It's good to know that human expertise is still going to be essential. Well, this has been a truly fascinating deep dive into the world of correspondent relationships.
It really has. I always enjoy getting to talk about this stuff.
And to our listeners, thank you so much for joining us on this journey. We hope you learned something new and maybe even got some ideas of your own.
Yeah, keep exploring. There's so much to learn about, the world of finance. It never gets boring.
And be sure to join us next time for another deep dive into another captivating topic. Until then, keep learning, keep questioning, and keep diving deep.